Well, the most powerful man in America is a man by the name of Jerome Powell. He's an unelected central banker, and he just spoke yesterday about what the Fed intends to do, either get us out of a recession or put us right in the middle of one.
Inflation has eased substantially while the labor market has remained strong, and that is very good news. But inflation is still too high.
So, on those words, gold skyrocketed to an all time high. And last night, the stock market also hit new highs across the board. Rally was the name of the day. So, what's really going on here? Kevin DeMeritt is the CEO of Lear Capital. We'd like to check in with Kevin every few months to see what's going on in this economy. Kevin, good to see you.
Good to be back, Clayton.
So, an interesting day because I feel like we're in the moment really of have and have nots right now. You have a lot of people saying, I can't rub two pennies together right now. Can't rub two nickels together right now to be able to afford my rent. My grocery bills are going up. I'm paying more for just about everything. Jerome Powell yesterday admitting basically that inflation targets of 2% not going to happen. Like we're throwing the towel in on that. It's going to be higher. But yet we're hearing from the Biden administration that this is a booming economy, that everything is great. So there really seems to be a total disconnect here. What did you make of Powell's comments yesterday?
Well, I think he's absolutely on track as far as you're probably going to have to lower interest rates sooner rather than later. So I think he's predicting three decreases in interest rates. He sees a recession coming, and so do a lot of billionaires and the people that I'm speaking to. There is a recession coming. If you look at the statistics and the indicators that usually will tell you if a recession is coming, like an inverted yield curve with a 100% track record of being correct, there's a recession coming. On top of that, there's a couple of other indicators that I think Jerome Powell is really looking at. One being the money supply. Look, money is like gas in a car. You need it to run the economy. So if you get a pullback in M2, where the money supply M2, which is really money in a checking account, your savings account, and certificates of deposit, money markets, things like that. Okay, so that's M2. You don't see it shrink usually, Clayton. It doesn't come down too much. But when it comes down just a couple of percent, it has large ramifications. And it's only come down that 2% four times in the last 150 years. And each time that it's done that, there's been a recession or a depression and double-digit unemployment. Okay, so that's one.
Wow.
The other is commercial bank lending. When commercial bank lending decreases by 2% or more, which has only happened three times since 1973, you get a recession. So not only do we have an inverted yield curve with a 100% predictability rate, we have commercial lending off by more than 2%, and we have the M2 money supply off by more than 2%. It's a scary situation for him because that usually signals a big recession, depression, 2008. Something big usually comes when all three of those indicators are going in the wrong direction.
And we see, of course, also hiring. Hiring has been slowing. A lot of small businesses now saying that when you had people quitting, the quit index, right? So a lot of people saying they're going to quit, and they could usually then go and get another job. But now a lot of small businesses saying they're pulling back on a lot of hiring right now, which is also incredibly troubling. You talk about the inverted yield curve, which for our audience maybe they don't understand exactly what that is. It's what bond investors are expecting, right, in terms of long-term interest rates and longer-term interest rates. So a lot of the people that would be investing in these longer-term bonds are saying, we see trouble on the horizon.
Yeah, basically an inverted yield curve means that the longer end of the curve, so 30 years out, is actually lower. They're paying less interest than the current 1 year, 2 year notes. So what that's really saying is the long-term guys, the long-term bond guys think, hey, there's a recession coming. He's going to have to lower interest rates. So we're betting that interest rates are going to be lower out longer dated than where we are today. That's what usually signals a recession. And bond guys in my world are much smarter than the stock guys. They really have to pay attention to the economy. They're just debt to corporations, the government debt, so on and so forth. So they're paying much better attention. They don't get so caught up in the frenzy and the buying at all-time highs like we're starting to see in the stock market right now. So much smarter guys, in my opinion.
I mean, so Powell really seemed. I mean, he's walking a fence here. I mean, really seems like you want the ultimate fence walking, tightrope walking moment right now because, but the Biden administration, of course, absolutely does not want a recession. So pressuring the Fed. We've got to cut interest rates. We've got to allow people to get in their homes, buy real estate, pay less for a car, all of that. We've got cars sitting on the lots right now. People can't afford them. People are swimming in credit card debt. And yet the Biden administration telling us everything is golden. I think in the commercial real estate, I think you bring up a great point. You have so much in the commercial real estate market right now is crumbling. And a lot of these small banks, you're seeing small banks folding as well, right? Because they can't, I mean, these loans are coming due and no one's going back to work. They're not going in these office buildings.
Yeah, there's going to be another bank crisis, in my personal opinion. It's not just me. I mean, there's a lot of people out there talking about a bank crisis, but there's $1.5 trillion of commercial real estate maturing by the end of 2025. I just ran this report on the debt maturing in the next 18 months. You have New York, which tops the list at about $40 billion, and these are loans that are horrible. They're high risk loans, and they're probably default. They'll probably default. So New York's about 40 billion, Los Angeles is 18 billion, Miami at 13 billion, Vegas at 10 billion, San Francisco at about 12 billion. You have a lot of these loans. My building that I'm in right now is 20% vacant. If they go and try to get a bank loan on this thing, they couldn't do it. The vacancy rate is too high for the bank to give a loan at the same loan value that is on this building today. So they're going to have to come up with whatever it is, $300, $400 million, some number to drop, the value of the loan, and you can't do it. And so these banks are stuck. I don't know what they're going to do, but some of them are going to go out of business, and there's going to be a lot of consolidation in the banking industry in the next year and a half, in my opinion.
I think
commercial real estate companies.
I think you're right about that. I think a lot of these small banks are going to be gobbled up. They're going to be gobbled up by the big boys, which is exactly what they want. It's all part of their plan. And I think, I'm saying this, and this may sound like a conspiracy theory to people, but we're moving towards a digital currency, and they want this money supply to be tight. So there's not actual currency floating around out there. They want to be able to control the currency. They can print as much of it as they want, and they want to move us towards a digital currency. And I think, is that why you think we're seeing gold hitting an all-time high? Like, what do you think accounts for this huge move into gold and silver right now?
Yeah, I think there's 34 trillion reasons that, the gold market is at all-time highs. But on top of that, you have Mark Zuckerberg sold $500 million worth of his stock. Jeff Bezos is selling his stock. Warren Buffett has sold $168 billion, or has $168 billion in cash ready to deploy because he's afraid to deploy it at this particular point. Michael Dell has $500 million that he sold. And Jamie Dimon, for the first time in 18 years, has sold JP Morgan stock. First time in 18 years. The top pick at JP Morgan in the commodity section is gold, predicting at $2,500 an ounce. That's about 12% higher than we trade at today. And if you look at the debt, Clayton, people are afraid of the debt. They can't, it's unfathomable that we are printing $1 trillion every 100 days. So there are a lot of different reasons that people are nervous about the economy and piling into gold and piling into the Bitcoin, which is skyrocketing along with it.
100 days, we're adding another trillion. I mean, we have the debt clock that we keep above us here on the show, on the set, shows our national debt. So 100 days is adding $1 trillion. I remember when I was in high school many moons ago, back in the early 1990s, and hearing about the debt, and we were approaching a certain level of trillion, and we were trying to all wrap our heads around it in my social studies class. And now we're adding that every 100 days.
Yeah. To give people some sort of an indication here, 1 trillion seconds is 31 years. At the end of this year, we are going to add 100 years of debt at $1 trillion, every 100 days. It is unfathomable. They're printing money so like it's water out there. I just don't understand how people are not more nervous about moving their money over to hard assets, the real estate market, the commodity, or, gold and silver, the real
Yeah.
estate market. I mean, you cannot hold paper money at this particular point.
I hope people are paying attention. We've been saying this for years on this show. I've been trying to educate people about it. Owning real estate, owning gold, owning silver, owning actual tangible assets, hard assets, which have been around for 5,000 years as a currency, as a way of doing business, right? Going back to the Roman Empire, for crying out loud. Owning real estate, gold and silver. So it's survived all manners of governments collapsing, and every fiat currency in world history has collapsed. What makes people think the US dollar is not going to be in that pile of rubble? I mean, what do you say? I see people commenting from time to time and saying, well, yeah, the gold market, though, is manipulated just like the rest of it. The gold market's manipulated. So can you really put your money in hard assets like that? What if I need to sell it? What if I need to? And I always remind people, Natalie and I are big investors in gold and silver. If I need to sell it for some other reason, I can do it within a few days. Like, it's held off-site in a storage facility. I can sell it in a few days, and it's converted, and I can make a transaction, right?
Absolutely. I mean, gold's the most liquid investment on the entire planet. If I'm in Hong Kong or England or here in the United States or over in Portugal, the gold is worth what it's worth. I can sell it anywhere at any time. You can't do that with a piece of real estate. You can sell it in the United States, but it's tough to sell someplace else. You can't do that with diamonds. You have to go get them assayed all over again. You can't do that with, stock a lot of times. So yeah, it's incredibly liquid. And when we saw 2008 and some of these corrections, that's what people used as it was moving up as a hedge to then go buy stocks at lower prices or real estate at lower prices. It gave them the liquidity that they needed in times when liquidity wasn't there for them, especially on the real estate side, Clayton. 2008, we have a lot of real estate investors, as you know, and either A, they had a tough time paying because people weren't paying them their rent, so they used precious metals as a way to liquidate that and pay the mortgage. Or, some of the guys that had great pieces of real estate and people were paying, when the real estate fell, they used the gold to go out and buy real estate when gold was high and real estate was low. So incredibly liquid.
Well, I'll get you out of here on this, Kevin. I know we've been talking about target prices for gold. So as an investor, I'm excited. The idea, Bank of America, I think, has a $3,000 price target for gold. Maybe it's higher than that. You just mentioned Goldman Sachs. You guys put together a $3,200 gold report that people can get if they go to learredacted.com. You've made it available for our audience, and people want to read about price targets. Can you talk a little bit about why you're seeing this over $3,000 price target for gold?
Yeah, so if you look at the debt, and we look at correlations, right? No different than the inverted yield curve or the money supply and the commercial credit that we were talking about. You're looking for things that are predictable. So there's a 92% predictability rate of where the US debt stands and where the gold price stands, and that is a 92% correlation. Where we are today, the price of gold should trade at $3,200. So if you look over history, if gold's higher than that correlation, it's a good time to sell it. If it's lower than that correlation, then it's a good time to usually purchase. So you look back in 2018, 2019, when gold kind of skyrocketed and was up in the $2,000 range. It should have been in the 2000s or $1,600s, $1,700 range. Good time to sell, and it did pull back. So this correlation is explained in our package of information so people can understand it, because you want that kind of predictability with your investing, right? We want to buy low, sell high. So that's in there, and they can give us a phone call or go to learredacted.com. It's debt and $3,200 gold. We have our gold investors kit so people can understand how to take physical delivery, how to sell, how to store it if they would like to store it, and even how to move their IRA over to physical gold if they would like to do that, their IRA or the 401k. And then we have some fun, I always love to be on the program and do something fun with your audience. So we have a fun gift, which is the old $1 silver certificate. So I bought a bunch of old silver Morgan dollars that I love. And there was 50 silver certificates in there. And it was way back when the dollar was actually backed by silver. So look, they're worth $5 a piece. It's not going to change anyone's life, but it's fun to show your kids that our dollar used to be backed by gold or silver. So, kind of fun to pull out and talk to people about. So we're going to throw the first 50 people who either call us or go to learredacted.com. We're going to throw in one of those silver certificates for them as well.
Oh, that's cool. I know you were texting earlier saying you've got these free gifts for the audience. So that's nice. That's nice. Our audience is smart. I know many of them are gold investors. Many of them are silver investors. So they can take advantage of that. They can give you guys a call at the 800 number there. You guys have been great partners for us for many, many years. So just real quick, I said I was going to get you out of here a second ago, but between gold and silver, like what do you think is the big play right now? We just see gold at all-time highs. If I'm a big silver investor as well, do you think, and it's cheap, I mean, relatively speaking, compared to gold, do you think, silver's a smarter play here or gold is a smarter play?
If you're looking for profit, silver is like falling out of a basement window. I mean, you're just not going to get hurt, right? It's too low. So where the price of gold is, the last time gold was near its record highs, the silver market was $47 an ounce and you're trading at around $24, $25 an ounce today. So based on the fact that I believe there is going to be a recession and those recessions usually push silver much higher, I would invest in silver. And if a recession doesn't happen, Clayton, then you have 100 million ounces of silver literally leaving the market in the solar industry each year. So the price is going to continue to move up. So absolutely love the silver from a profit play.
Yeah, from a profit play, also a commodities play right now. The demand is off the charts for everything that we need right now in these products that the Biden administration is pumping billions of dollars into right now for solar panels and everything else. So, Kevin, we always appreciate you joining us, giving us some perspective on the Fed's comments. As always, we'll keep our eyes on what this recession portends for the United States and as the U.S. dollar continues to be deflated with the money printing machine that they've got in Washington. Kevin, great to see you. Thanks so much.
Yeah, thanks for having me on, Clayton.
All right, thanks so much, Kevin. And yeah, you can grab that free gold report, $3,200 an ounce. We've been talking about it for quite a while here. You can go to learredacted.com to grab that free gold report. I mean, when we started investing in precious metals, a couple of years ago, and we see all of these price targets, $3,000 through $3,200. And when they want to get rid of U.S. currency and move towards a digital currency, I think you're going to see this continue to climb up right now.
Yeah.